When it comes to telecommunications, three companies essentially just dominate this entire industry in the United States: Verizon, AT&T, and T-Mobile. And for this stock analysis video, we are going to be analyzing Verizon Wireless. A quick overview on the company profile. Verizon Communications Inc. offers communications, technologies, information, entertainment products, and services to consumers, businesses, and governmental entities worldwide. Its consumer segment provides postpaid and prepaid service plans, internet access, and notebook computers and tablets, wireless equipment, including smartphones and other handsets. And wireless enables internet devices such as tablets and other wireless enabled connected devices such as smart watches. It also provides residential fixed connectivity solutions including internet, video, and voice services, and sells network access to mobile virtual network operators. As of December 31st, 2020, it had approximately 94 million wireless retail connections, 7 million broadband connections, 4 million Fios video connections. The company's business segment provides network connectivity products including private networking, private cloud connectivity, virtual and software-defined networking, and internet access services, and internet protocol-based voice and video services, unified communications and collaboration tools, a customer contact center solutions. This segment also offers a suite of management and data security services, domestic and global voice and data solutions, including voice calling, messaging services, conferencing, contact center solutions, and private line and data access networks, customer premises equipment, installation, maintenance, and site services, and Internet of Things product and services. As of December 31st, 2021, it had approximately 27 million wireless retail postpaid connections and 482,000 broadband connections. As y'all can see, Verizon has a lot going for it, and honestly, it's by far the biggest of the telecommunication companies in my opinion. With a price of $53.39, are these fundamentals matching this ticker symbol? Let's find out. Howdy everybody, and welcome to another stock analysis video. We're going to be analyzing Verizon today, and well, the reason why I kind of want to analyze is because it has fallen a lot these past $2.56. Payout ratio in regards to net income is 48.18%. A 5-year growth rate of 2.11%, which is fairly low. It's not the highest, especially for a well-established company like this. Dividend growth: it has raised its dividends for 8 consecutive years. Ex-dividend date was October 7th. Payout date will be November 1st, and they pay their dividends quarterly. Coming over here to the discounted free cash flow calculator, we got Verizon, $53.39. Okay, PE of 10.04. That is super low. We would like this to be less than 20. So right now, this is already a screaming buy. Market cap of $221 billion, and as I said, annual dividends per share is $2.56. Now, can they afford this? We're going to find out in just a bit. Coming over here to the actual metrics, we got the growth assumption of 2%. Now, coming over here to Seeking Alpha, we have the revenue growth year over year at about 2.42%, which is fairly low in comparison to what you would think for a massive corporation like Verizon. So I am actually going to try and match this revenue growth year over year. However, at the end, I do want to mention something that might be able to increase it, investors, or giving them a piece of the pie. Very important metric. This is essentially the silent killer. We got 4 billion shares to 4.14 billion shares. As you can see by this graph, it is increasing, but again, this trend line is essentially almost flat. However, we can actually see that they are issuing shares at 1.53%. And lastly, we got cash and equivalents, and as you can see, as of 2021, they have almost $10 billion in cash and equivalents, with an average cash equivalence of $7 billion. Now, with all of that said, we finally got the target share price of Verizon, assuming a 2% growth rate, at $61.72. Adjusting for debt, however, it goes down to $24.06. Adjusting now for a margin of safety of 5, 10, and 50%, we got $22.85, $21.65, and $20.45. Now, you're probably wondering, okay, $24.06 after debt with a PE of 10? You want this to go further down? It's already at 53 with a PE of 10, and you want it to go down to 24? That is insane. If you increase it, it'll be just a couple of pennies. Now, let's just try something. Verizon is a telecommunications company. We know that right now, 5G is the big thing, the big talking point of the future. It'll revolutionize everything like the 4G did. So let's actually, instead of making the growth assumption at 2%, let's just say it's about 5%. Let's give them the benefit of the doubt. Doing this, you can actually see all the changes from all these metrics for the projected numbers. As you can see that essentially all of them, when it came to net income, cash flow, and revenue, the trend line did slightly increase in slope. So maybe if you believe that Verizon would be $2